Welcome back to the Money Master Unleashed podcast. This is Adam Olson with you today. In today's episode, I'm going to educate you guys about tax-free income in retirement. And a way that you can get tax-free income in retirement is from using Roth conversions. Now, I've helped dozens of clients over the past several years use Roth conversion strategies either in one tax year or in many tax years to potentially lower significantly the tax burden that they're going to have to pay in retirement based upon the amount of dollars that they've saved. You see, this is a simple strategy that you can implement with your advisor and your tax preparer, your CPA, to help alleviate potential large tax burdens that you may have to pay in retirement that could prevent you from living your best retirement life that you've imagined for yourself. So let's get started right now with these 10 tips. And if you would, share this video and like my channel and subscribe if you find value in this. Let's get started with number 1. Why should you consider a Roth conversion strategy with some of your retirement dollars? The first thing, tax diversification. You see, diversifying your retirement income sources is extremely important. It can minimize some risks such as tax risk, sequence of returns risk, and longevity risk. You see, because Roth IRA accounts, you don't have to take out at a certain age. You're not required to. And what's really cool about them is it allows for you to have tax-free income in retirement. So tax diversification is number 1. Diversifying your retirement income sources. If we have quite a bit that's tax-free, you don't have to worry about increasing tax burdens in your retirement. Let's talk about number 2, tax bracket management. See, if you convert a traditional IRA to a Roth IRA, you pay tax in the year that you do it, which may not sound too attractive to you right now. But what's really attractive and why you should consider this strategy is it can potentially decrease your tax liability at retirement time. You see, if we have equal money spread out among different buckets, we're able to pick which bucket we access and when. So tax bracket management is a huge tool that you can use in retirement if you've done these Roth conversions and you have good sources, good amounts of Roth income available to you at retirement time. The third thing that I want to talk to you about is it alleviates the potential of future tax rate increases. You see, with where our economy's headed, where the government's headed, might not be the best picture that we've seen historically in the United States. And so what a lot of experts are anticipating is tax rate hikes, potentially here in 2026, potentially here in 2030. Now, if you raise your hand today and you do this Roth conversion strategy, shifting assets from a pre-tax account to a post-tax account and paying tax today, you alleviate any future tax rate increases that you may have to pay on those distributions when you take them out. You see, money that we get in this post-tax Roth bucket, you get tax-free at retirement, and you don't have to worry about these future tax rates if that money's tax-free for you. The fourth thing to consider, and a huge benefit of Roth conversions, is long-term growth. You see, if we get money in a tax-free bucket, and the earnings and contributions, they grow over time, you can take all of that out income tax-free. And we don't have to access it at your RMD age, which is required minimum distribution age. So if you don't need the money, it can continue to grow. Long-term growth is it's the fourth reason why you should consider a conversion strategy. The fifth one, I've already hit at this a little bit. But you see, with traditional IRA accounts, you have to take out at a certain age. Whether it's 72, 73, it used to be 70 and a half. There's certain ages when you have to take out of your IRA your pre-tax accounts. And what that may do for you is that may bump you in a higher tax bracket. It also could potentially affect your Social Security taxation and your Medicare premiums that you're paying. But guess what? If you have Roth IRA accounts, you have no RMDs to worry about. In addition to that, if your beneficiaries inherit a Roth IRA, guess what? They have no taxes due on that money either. Which brings me to my sixth thing, the sixth reason to consider this, is it's an extremely efficient legacy planning tool. And what do I mean by legacy planning tool? I just told you, these Roth accounts, they can allow for a tax-free transfer to your beneficiary. So say I have a Roth IRA right now, and this thing grows to be $1 million and I never touch it. And I only put in, say, $200,000-$300,000 into this thing. Well, all of that growth, if I pass away and never touch it, it goes to my kids. They get those Roth dollars income tax free. They don't have to pay any tax on those Roth dollars, and they can do what they want when they get those assets. That's number 6. It's an efficient legacy planning tool, a great way to pass wealth on to a next generation with no taxes due. Number 7, let's talk about number 7 here, healthcare cost. A lot of people don't think about healthcare costs in retirement time, but it can be a huge cost for you in retirement. You see, if you have a Roth account, you can take out of these accounts income tax free again, and you can use it to cover any potential large healthcare bill that you have. Whether it's a medical bill, nursing home bill, ambulance bill, whatever it is, you can use these Roth accounts for distributions to pay for healthcare cost. In addition, number 8, income in retirement. This is a very important one. Roth conversions, if done properly, they can supplement your retirement income because we can get you more money out of Roth accounts for your spending today, and it's not going to increase your tax liability that you have. You see, if you have Social Security and you have pensions, maybe an income floor that I talk so much about, you're going to have a certain base level of taxable income. And if that base level of taxable income is here, but your spending need is up here significantly more by $2,000, $3,000, $4,000, you don't want to pay more taxes on your income need? Guess what? Take it out from your Roth. It's income tax free. You don't got to worry about it. That allows you to live your best retirement life that you've ever imagined because you can get tax-free income from that account. Let's talk about number 9. This is a big one for a lot of people in their 30s and 40s to be thinking about. Roth conversions can assist you in an early retirement. So let's just imagine this. Say you're 50 and you're thinking that you want to have an early retirement, maybe age 55. Well, if structured properly and done at the right time, Roth conversions can give you a tax-efficient income source at age 55 when you want to retire. And you don't have to worry about the age 59 and a half rule like you do on some other taxable retirement accounts. Because your contributions to these accounts, if they've been set up for over 5 years, you can withdraw those income tax-free before age 59 and a half. There's that 5-year rule that you need to pay attention to. But if you want an early retirement, you should definitely not be sleeping on Roth conversions. And number 10, they allow you flexibility in withdrawals. So lastly, Roth conversion strategy, if done properly, will give you flexibility in your withdrawal strategy. Like I told you, you had that 5-year rule with Roth IRAs. And once you've had that thing established for 5 years, you can get penalty-free distributions of the money that you've put in at any time that you want after 5 years. This gives you liquidity and flexibility in your retirement planning, which is what we all want. So if you're interested in how a Roth conversion strategy would look for you, we may do it over 1 year, we may do it over 8 years. But I would encourage you, if you're looking at your retirement plan and everything's in pre-tax dollars, you have no dollars in Roth assets whatsoever, I would highly encourage you to check out a Roth conversion strategy and see if it's appropriate for you to allocate some of your pre-tax dollars into a Roth account to potentially save you thousands of dollars on your retirement income every single year. So if you want to go through that strategy, if you need help walking through that, I'd encourage you to visit my website. I'd love to sit down with you and have a conversation about how we can implement this strategy for you, just like I've done for dozens of clients, and we're able to save them potentially thousands of dollars every year. Like the video, share it out if you would. Thanks for listening. This podcast is for educational purposes only and may include references to concepts that have legal and/or tax implications. It's not to be construed as legal or tax advice. Such information or opinions is subject to change without notice and is not intended to use as an offer or solicitation with respect to the purchase or sale of any security, insurance products, or offer of individual investment advice. Any strategies discussed may not be suitable for everyone. Mutual of Omaha Investor Services, Inc. does not provide legal or tax advice. Please consult with your appropriate professional regarding your personal situation prior to making any financial decisions. Securities and advisory services offered through Mutual of Omaha Investor Services, Inc., member FINRA SIPC. Riser Insurance is not affiliated with Mutual of Omaha Investor Services. Investing involves risk, including the possible loss of principal. Past performance does not guarantee future results. Diversification does not guarantee a profit or protection lost against loss in a declining market. Purchase of life insurance is subject to meeting underwriting requirements. There is no guarantee if an individual will be insured. Annuities are long-term investments designed for retirement purposes. Withdrawals of taxable amounts are subject to income tax, and if taken prior to 59 and a half, a 10% federal penalty tax may apply. Guarantees are backed by the claims paying ability of the issuer and are subject to their terms and conditions.